Happy Halloween, everyone. My name is Brian Overby. I'm the Senior Options Strategist here at OptionsPlay. And this is going to be a presentation, actually the third part to an initial presentation about how to set up butterflies and modifying those butterflies. So we looked at an adjustment in our last presentation about taking a butterfly and adjusting it into a short put spread. So the butterfly that we started with was a put butterfly, but we did talk about other butterflies in the initial seminar. We talked about a skip strike butterfly. We looked at just a standard modified butterfly and looked at the standard butterfly. So this is the third part in that series, and we do have access, if you are Options Play client, you do have access to the other butterflies. And also inside the YouTube, Options Play YouTube, you can find all three of these events. Okay, so fix a losing spread into a soaring butterfly. Yes, that title scored well in search. Anything where you're fixing a losing trade is always of interest. And today's trade that we're going to do is based off of today's market. We looked at a long call spread, and this actually could have happened in the marketplace this week. And I tried to set it up that way because the market did take a ugly turn going into the end of the week. You could say maybe it was spooked by the Halloween October 31st date. But with that said, if you want to ask some questions during the event, you can do so via the Q&A box. The quote box, or I should say the chat box, is opened up, and feel free to chat amongst each other. But if you want me to address your questions, please do put them in the Q&A box. I'm going to ignore the chat box through most of the event. So with that said, thanks for coming on. I guess this is a holiday. If you have kids, you definitely think it's a holiday. Options Play Education. We're empowering you to trade sustainably and confidently. And we do a lot of educational events, and they're provided, share them with friends. We're happy to share this education. And obviously, ultimately, we'd like you to become an Options Play client and, all the benefits that you get with the software. Okay, so we still have a disclaimer. We want to make sure that I'm going to be using real prices today. This is not meant to be a recommendation, and past performance is not a guarantee of future results. There's for that. Now, you can take a screenshot of this if you want to put your phone up there. You will have access to these slides. If you do screenshot this, they will be emailed to you. But check out what we have available, the free trial for OptionsPlay.com. And all you got to do is sign up by scanning that QR code. All right, so here's the butterfly team. This is what I set up in the very first seminar that we did. And I did it all with puts because a lot of times I do have a strategy that I've been doing for years and years in the SPX when I feel right, when it feels right. It's not like I do it every week in and week out. But I do feel in general that when we get past this election, it's going to free up the market. And what I feel like right now is that the VIX has a stranglehold on the market. Anytime we get a run up, there's a sell-off. There's a run to the S&P 500 index put options to buy some protection. And that ultimately is what drives the VIX, right? A lot of people don't necessarily know that the VIX index is really a function of the implied volatility premium in the S&P 500 index put options. And if you ever look at the S&P 500 index, you'll notice that there's almost always more open interest on the out-of-the-money puts than there are on the out-of-the-money call. I'd say 80% of the time that's the case, maybe even higher. But you're going to find instances where that may not be the case in some markets. That would be a very bullish market. But bottom line is that that's why the VIX gets the fear index name in that It's really the fact that the S&P 500 index is used by a lot of institutional investors and some retail investors to protect their portfolios. So when people are willing to pay up for protection, that will increase overall the VIX index because that means they're willing, that implied volatility is raising on those option contracts. Okay, so started with a standard put butterfly, also looked at a modified put butterfly and a skip strike put butterfly. Okay, so today what we're going to do is you can roll into either one of these, and this is the main reason why I have this slide. But I'm just going to roll into a standard butterfly, but we're going to be on the call side of things. Now, my seminar that I did on puts was all about, or that I did on butterflies was all about puts, but the same concepts apply on the call side of things. All right, so broken wing and skip strike are the same. They are. I don't like skip strike, or I don't like broken wing, and here's why. Here's a broken wing, and I do think that I should address this. Now, I wrote a little book called the Options Playbook. I think it's right over there. I don't know if you can see it in the screen or so. And I chose to call it a skip strike butterfly because you're literally skipping a strike. You're embedding a short call spread into the butterfly that pays for the butterfly. And I always look at a skip strike butterfly as an alternative to a short spread, not as an alternative to a butterfly. So you're right in that it's a modified butterfly, and that's probably the more used search term, but I think the skip strike is the correct name. And so I'm going to go with that. And from here on out, it's called a skip strike butterfly, not a modified butterfly. All right. Wonderful. Thanks for the question, by the way. And so this is going to be a short and sweet event. First of all, we got Halloween. We need to go on out and earn some candy. And hopefully this trade is actually going to maybe be more of a cavity than a candy, right? Because we're going to look at a scenario and say that it goes against us. A lot of people know what they can do when the market goes with you. But in this instance, what do we do when it goes against us? And I actually put this or had this sent out in the email, I should say the marketing email that went out, this isn't a perfect hedge. The one thing I love about the hedge that we're going to talk about is that we're not going to add any additional risk to the trade, and it's not going to cost us any money. But when we're all said and done with this trade, all we got is a chip in a chair. And if you've never played poker, you might not know that reference, but there was a person that was in the World Series of Poker that had a chip and a chair, and that person came all the way back and ended up winning that tournament. And that the quote was by that person saying that, if all you need is a chip and a chair and you still got a chance. And that's the way that I approach this trade. My attitude on it would be that, another way to say it, just a lot of little fun little analogies, is I don't want the cheese anymore, just let me out of the trap. Okay, so I'm probably going to be doing some of these in the daily play inside the options play after the stranglehold that this election seems to have on the marketplace right now. And as we're going into the end of the new year, we just had a real big week because all the Mag 7 announced, well, not all of them, but most of them announced this week. Amazon just announced earnings right now. It looks like the stock is up a little bit. I obviously didn't have a chance to really look at it. And Apple is also announcing earnings today. So with that said, the holiday season is coming. The election is coming. Let's get this stuff out of the way. And the way that I like to do my trades, if I want to get bullish on the marketplace, is to look at the S&P 500 index. And I prefer this over the SPY because that's going to be a question that I'm going to get. And the main reason, there's a couple of reasons behind it, is first of all, the tax advantages of trading index options, the 60-40 rule, if you're not in a retirement account. Now, you can do this in a retirement account if you get approval from your brokerage firm. And on top of it, it works better with higher priced underlying stocks or indexes. And part of the reason why is just the dynamic of the fact that if we're looking at a spread, and let me introduce the spread to you, my long call spread in the SPX that I set up today. Actually, I used Monday's quotes, but I set it up today. Yeah, I did this. Yeah, I used Monday's quotes. I had a screenshot of it. Okay, so in that instance, on this Monday, on the 28th, the SPX was at $5,834.85, and the VIX was stubbornly hanging around that 19% level. It's up a little bit more today because the markets got ugly. But with that said, we bought an in-the-money call option and at the same time sold an at-the-money call option. Now, I like this in that you're selling more premium than you are buying. In other words, this option contract right at this point in time was 15 cents out of the money. So this is all time value. In this option contract, we're 15 points in the money. This one should be, oh, I screwed that up. This isn't the 25. Okay, let me see if I can edit this. Let's edit this right now because it's going to be in effect. This will be, that's 10 points. This is 20. I'm pretty sure I got the right numbers still because just the way the math worked out. But that changes that. And this would be 20 here too. And that's 15 points. There we go. All right. So there's that. So first time setting up this strategy in this platform. So let's go back to the slideshow. And if we're doing this, this is 15 points wide. And if I look at this and I set up this trade, I'm selling more time premium than I'm buying. This entire trade is done, it's 15 points wide, and it's done for a net debit of $8.75. That means for every 1-by-1 long spread, or another term would be a vertical spread, inside the Options Play platform, we'd call this a vertical spread. And if you're doing this trade 15 points wide and you're selling more time premium than you're buying, a weird thing happens with your break even. Your break even is actually below where the current marketplace is at. So the max risk is $875 or $875. The break even is this price plus this price. So at expiration, it would be, did I screw that up then too? 58.33. No, it's going to be lower than that. So 58.20 plus 875. 58.28. So in this instance, our break even is the strike price. Of course, I had to pick the wrong strike price there. The strike price minus plus the net debit paid. So we have a lot of leeway in this instance in that we are selling a lot more time premium than we are buying on this trade. And if we do that and we look at this trade, our outlook for the market is that it just needs to stay where it's at, or it can drift higher, and we're still positive on this trade. So some people may say, well, why wouldn't I do the put side of things and actually bring in a credit spread to the trade? And you can start with the short put spread, but I do think it's a lot easier to just understand, and it also helps with the adjustment to start with the long call spread. But the moral to my story here is that if you pay attention to the time premium that you're buying versus the time premium that you're selling, you can pay a net debit for a spread that actually has positive time decay on that trade. So the market's at 58.34. If the market just stays above 58.28.75, if it just stays above that level, we are then profitable on this trade. So we can drift a little bit lower or we can drift a little bit higher. Our maximum risk is 875. If the market goes below 820, that's the maximum that we can lose on the trade. And if I'm looking at this trade, this is the way I like to approach some long call spreads. Now, if we do the trade and it goes up, you're not trying to make all 15 points in this. So I at least got the max profit right here. So the max profit is $6.25. Now, it's not, it's not a 50-50 bet, right? We're not paying $7.50 with the hopes of making $7.50 on the trade. We're paying $8.75 because we got to pay a little bit more because we are actually going deeper in the money and we are profitable if the underlying does not move at all. So we pay a little bit more for that and we give up a little bit of the upside on the trade. So I still don't mind this risk reward, and it has a little bit to do with the higher valuation of the S&P 500 index, a little bit of the volatility skew that happens, but the market is at 58.35, and you have this opportunity to put this trade on, and if the market drifts lower, still be profitable on that trade. Screen is blank. All right, is the screen still blank? No. Oh, no, it's not. Okay. All right, here we go. Let's keep going. Let's soldier on, as they say. All right, so now I'm going to show you the long call butterfly spread. So if we went in and did this trade and we bought a 15-point wide spread in the SPX, this would be centered around where the stock is at. This is actually from the put butterfly slide, but the stock would be a little bit more closer to where this is at. But the profit and loss graph still makes sense. This is what a butterfly would look like. So if we did the long call spread, now I'm just going to show you the difference in cost with the butterfly. So a butterfly is a long call spread. The 52.80 to the 58.20 to the 58.35 is 15 points wide. You buy one, you sell one, and that's our long call spread. Now you go out and then you go from 58.35 to 58.50. That is a sell of the 58.35 and then a buy of the 58.50, and you end up with a short spread. So what is a butterfly? It is a combination of a long spread and a short spread that has the middle strike the same. So you are selling one of these option contracts right here. You're selling one of those to go along with your long spread, and then you're selling another one to go along with your short spread. So if I'm doing this entire trade, now the credit of the short spread helps pay for my long spread. So $3.40. So where were we at? $8.75 minus $3.40 equals $5.35. So that's the total difference between these two trades, right? Now, way different outlook. If I do the long call spread, I have substantial upside potential, right? As the market moves all the way to the upside, I have substantial upside potential. In this, I need the stock to go to 58.35 and just stay right there. And now I got the wings. If it blows it out to the upside or the downside, I'm unprofitable, but I have a lot less risk overall, $3.40. Now, expiration in this trade when we put this away was Friday. So you could say it's 4 or 5 days, depending on if you're going to count the Monday that the trade was on. But that is the length of this trade. And that's also this trade when we put this on too. I want to emphasize that because it's very important, especially in the SPX, that you have zero DTE options. You can trade. You can go in on Monday and have an option contract and do this butterfly and set it up so that it's done on Thursday, or do the long spread and have it set up so it's done on Wednesday. You have every single day to expiration every single day of the week is going to have an expiration date. Okay. So I say that because that really affects your ability to adjust this trade. So this week was a very interesting week in that the market started to drift higher on Wednesday, and then it was very schizophrenic on Wednesday. It was up a little bit, and then it ended up down. And I would have adjusted my long call spread on Wednesday if I would have put this trade on, especially on the close of the market. Now, what ends up happening here, and this is what I want to highlight, is that the short call spread, and I want to make sure I got my strikes right, is $15.35. So that's a heck of a lot of credit for 5 days to expiration by just selling an at-the-money call spread here. Remember what we paid for our trade, $8.75. This net credit is now $15.35. Our break even for the trade is 58.2875. I got that right. 58.2875. All right. I do have a degree in math, but I don't like doing it on the fly in an event. And if I look at all of these, here's my simple adjustment. I don't care that I'm paying $3.40 for this butterfly. I know my max upside on the butterfly, the distance basically from this strike to this strike, is going to be 15 points or $15. I know that that's the maximum that it could be. But if I'm doing this trade, if I'm looking at this trade and I have this position on, if the market goes up from the beginning, no worries. If I wake up and SPX is up 0.5%, which is a good move in the SPX, very rarely do you get the type of move on a percentage basis that we get today. No, the math is right, Rob. No, it's not. So let me get the math all right. Let me take 2 seconds here to get this straight. I apologize, everyone. 50 4140 times 2 equals 82 minus 50.15 minus 36.05 equals 340. Okay, so that trades 340. So the 5580, 15 points. Let me go make sure that's right, because it should be a lot more, because if this is, that's 11. Oh, I got the wrong price on the call side of things. 875. No, that's right. What's wrong here? 4140 minus 50.15. 875. And that makes sense that it would be 875 for a 15-point spread. I got my quote, so let me grab it. Let me grab it here. I'm going to stop sharing for a second. All right, so let me grab the math on this. Anybody dressing up as something fun for Halloween? Yeah, it says 535, but that's not the right number. Let me go look at it. I hear you. I see everybody in the chat. I'm seeing you. I'm riding with you. There we go. All right, the math is right. All right. Okay. Let me get my thoughts straight on this. Here we go. PowerPoint. And I'm going to make sure that I'm sharing my screen with you. Slideshow. Okay, now we're back. So if we do the math, it all works out right. So this is 535. Escape. Exit full screen. I apologize that I had this wrong. 4140 minus 3605 equals 535. All right. So if I do this and I have this on for $5.35 and the market moves to the point, let's say it goes down 20 or 30 points in this spread would start trading for about half of this value. And I just wanted to make sure that that was all correct. So if the market goes against us and we're losing on our spread, so in that instance, our long call spread, exit full screen. No, I didn't want to do that. Our long call spread would be, we'd be losing on this trade. This trade would come down and this spread would be trading somewhere close to around $4 on this trade overall. So I put the trade on for $8.75. The market goes up, I sell, I'm out of the trade. The butterfly was trading for $3.40. But if the market goes down, and if I ever see this credit spread trading for $2.50 or around $2.25, I'm going to roll into that spread, and then I end up taking the net debit of this trade down. Let's say we sell it for $2.25. So $8.75 minus $2.25. That would be $6.50 overall. So that would end up being my max risk on the trade. And then I'm long a butterfly and I'm hoping that the market will bounce back. So I have two different options that I can do here. And if I had a platform, I would go in and just run it through the platform. But I have two different options on this spread. If I put this trade on and I start out in a butterfly, it costs me $3.40. I'm going to pay a lot more for the butterfly. If the market goes down and the market is going against me, this credit spread, this is my signal to trade. If I see this credit spread trading for around $2.50 or between $2 and $2.50, I'm going to sell that trade, and then I'm going to be into the butterfly, and I'm going to have a 15-point wide butterfly, and I'm going to reduce my risk. So instead of just getting out of this trade because the market went down and I'm paying, and I sell it and I close the position for $4 or $5, I'm going to adjust the trade, sell this net credit spread, and try to bring in at least $2 to $2.50. And then I have a 15-point wide butterfly that I ended up paying $6 for. And that's my chip in a chair. If the market goes down and it goes against me, then on that trade, I'm okay. And I can still be in the position and have a chance for the market to bounce back and go towards my strike on my short butterfly at expiration. So the way that I really kind of look at this trade is that if I'm starting out in the long call spread and the market is, I start out in the long call spread on Monday. Hopefully Tuesday I can make it by. The market kind of stays the way that it is. When it gets to Wednesday, if the market has drifted about 0.5% lower, then I'm going to look to adjust that trade at that point in time. If I can adjust it on that day, now I'm into the height of time decay, especially in the S&P 500 index. So we have all the time decay on Wednesday, all the time decay on Thursday, and then on Friday it becomes a very interesting day if we get the markets to come back. If not, I've reduced my overall risk of the trade. I've taken a few dollars off the top. I added no more additional risk because all I did was roll into a butterfly, and hence the reason why I use the analogy you have a chip in a chair. Now, on the butterfly, I just want to get out of this trade at this point in time. I had 3 scenarios where I could make money. I had scenario 1 where I have the butterfly long spread on and the market doesn't move. My break even is 58.28. Market stays there at 58.34. I still did just fine on this long call spread. Market goes up. Well, that's simple. Just got to decide when I want to take it off. One is enough profit. Market goes down. I adjust the trade. I go in and I roll into this butterfly and I wait till this gets to a net credit of about half of it. And I really thought it was a lot more of a credit, but about half of it in this trade. So once that gets cut in half, then I come back in. I know what I did when I mixed the metaphors, but when it comes back in, then I would sell this and bring in a few more dollars and lower my risk, but still have a chance that the market can come back. And the wonderful thing about that is that a butterfly really wants time decay to be your friend. So you start on Monday when time decay, it obviously matters. It always matters in option trading. And if you're right on your forecast, you need some time decay to work, but your positive delta, every time it goes up, you're making money. Market stays where it's at. Time decay is your friend. You bought less time than you sold, so time decay can just work its way out. Market goes up and all of a sudden, or market starts going down and drifts down. One of the nice things about the index is very rarely are you going to have that gap down of 1 or 2%. You always have that a chance to adjust it. So you see this trading for about half of this net credit right now, about $2, $2.50. You take off a part of your risk. You add no more additional risk. The brokerage firm doesn't care that you're in a butterfly or a long call spread. There's no more additional risk. And you end up in that trade and you do, and you have this trade on now. Instead of $8.75, you have it on for $6.75. And that's the way you adjust the trade. Now, if the market doesn't come back, you still got to be prepared to lose this, right? Whatever you're in for, the net debit to the account of $6.75. It's not a perfect adjustment, but instead of just closing out your position, which so many people just don't seem to be able to do, I've had a friend of mine that's taught options for a long time, and they've always had the idea that if you I'd rather teach options to a 5th grader than an adult, because if you tell somebody, a 5th grader, to do something, they'll do it. If you say to an adult, well, all right, we're going to get out when you lose half of your value on your trade, and say we're going to get out at $4, they'll say, well, it got there, but the moving average bumped into the MACD and it formed a hanging doji, and there was no way to get out at that point in time, right? So the biggest thing that I have found, especially with people that are beginning traders, is they don't want to give in and just tap out. This strategy works as an alternative to somebody just closing out the trade and just being done. The name of the seminar should be A Chip in a Chair. It's that straightforward, because you have two scenarios where you're fine. You have one scenario where you're not, where the market goes down, and it goes down quite a bit. We're talking a fairly strong move to the downside of about 0.5% to 1%. I adjust the trade, and then I just hope that the market comes back, and I still have a chance to even get out at profitability. Because if I do end up in this for $6 into this butterfly trade, the market it's still, the maximum is worth $15. It's just got to be within that range on that expiration date. And that's the adjustment. Now I can try to go through this, because I obviously screwed up this slide, which I'm going to adjust. I got them all, I've already adjusted them. So when we send them out, the slide will be there. But let me see if I can pull this off inside the platform right now and see where the butterflies are at. Now the markets are all ugly at this point in time. They closed and we were down so much on the day. Let's go and see what I am see if I know what I'm talking about. Maybe I don't, who knows. So here's our bull call spread. We're gonna go out in the short term. So let me modify this. Go midpoint. I gotta go midpoint, and usually midpoint fills are good in the SPX. Oh, I can't do the SPX. I got to do a SPY. That's why I had the SPY up there. All right, SPY is a lot harder to deal with, because you're talking about a 1.5 point spread or a 2 point spread if you're going 20 points wide, or if you only go 10 points wide. If you want to start off with lower risk, you can also go that route, and that would be 1 point wide. Oh, shoot. I didn't anticipate the SPX not being there. All right, let me see if we got any questions. Let's go from there. Join webinar is available. If you sign up, there'll be. I appreciate that, George. I see you. I hear you. I just had my math wrong. I don't know why. I've given this seminar probably 100 times, just not with these slides. All right, Mike, I'm trying to address all the questions that are in here. Yeah, we'll send out the revised slides. Join late. All right, so now that I got everything together, let me do as George says, and don't talk about analogies, and just look at the PowerPoint and the trade. Now that I got all the math right on it. If I'm looking at this trade and I'm setting this trade up, what we're going to do is we'll start in with a long call spread. And the long call spread, I've done this trade before. It's all about the adjustment after the market has moved. I've done it with 10 points, which the only downside of the 10-point wide butterfly or long call spread is that if you roll into the butterfly, you're only 10 points wide. In the SPY, you'd only be 1 point wide. And it's very hard to get something out of that trade when you are so tight on a large index. So I like to go 15 points wide, but you have a little bit more upfront cost in order to do that. So if I'm doing this trade and I come in and I pay the net debit of $8.75, I've already explained the benefits of being in the trade, in that if I do it, I pay $8.75, and my risk is going to be that if the market stays above 58.28, which is, I'll do the math on that, and I'll make sure I got it right. 58.3485 minus the 58.2875. Okay, so you have 6 points that the market can stay within, and you're still profitable. So if the market drops 6 points, this trade is still at break even. $6.10 to be exact. Now, the market goes up. Okay, normally if I'm doing this trade, the maximum you can make on it is 15, or the maximum it's worth is 15, or $6.25, which is 15 minus the 875, $625. All right. So if I can sell this thing for $13 or $14 on my long call spread, I am going to get out, and I'm going to do that especially if I can do it early. Let's say we get a 1% move to the upside on Tuesday. We put this trade on Monday on the 28th. If we get a 1 or a 1.5% trade to the upside, this would be trading anywhere from $13 to $14, somewhere right in that range. I would then get out of the trade, especially because time decay is there's just too much time premium to try to wait it out to try to get the maximum on the trade. In order to get the maximum on the trade, the 58.35 call has to wither away. It's right now trading for $41.40. You can't make the maximum on the spread until this gets closer to zero as far as time premium is concerned. That's all time premium right there. Okay. Now, market goes against us. Let's say the market goes down 0.5%. If it goes down 0.5%, the initial butterfly you were paying $3.40 for. If you just put on a butterfly at the money using calls on Monday, if you did that trade. If the market goes down, what this is implying is that this butterfly, this short spread, is $5.35. Now, I want to reduce my risk. If the market goes down, I'm losing money on this trade, right? If I'm down 0.5%, this is trading for around 450, 475, and I could just sell it and get out and use the rule that if I'm down 50% on my trade, I want to get out of the trade and just move on. And that's a viable strategy that I've seen a lot of long spread traders do, right? This is my alternative. Instead of selling it, what I'm going to do is watch this short spread. And the math will be different depending on the day. If it's on Tuesday, this math will be fairly accurate. It'll be fairly close to this price when you initially put it on. Wednesday, time premium still is very sticky in the S&P 500 index. Now, let's say the market then starts drifting down. If it goes down and it gets to the point where I am 20, 30, maybe 40 points below where we started, this would start trading at about half of the net credit to the account. Half of it would be $2.50. So we'll call it $2.50. That's where my number would be. I would want to bring in, if I could bring in $2, I'd still want to do it on this trade, as opposed to just selling the long spread outright. If we get this trade done for a net credit of $2, we then have this long spread position on in our account. And if we do that on this trade, we still have risk of $6.75. But if the market comes back and lands within the strikes of our butterfly, there is a chance that we could get out at break even. We would have to sell our butterfly for close to the net debit that we paid, $6.75. It's a 15-point wide butterfly, so that's very feasible to be able to get that type of premium for it. And now I can just let the position ride if I want. If I see it come within the range, I get out, but I don't want to make another adjustment to this trade. I've had two scenarios where I make money. the market stays where it's at, the market goes higher, I'm okay. And I introduced a third scenario where I'm dead wrong on my forecast and the market can come back and I can still break even. And that's quite simple. So this is a great question from Wesley. Does the adjustment work on a normal call vertical? It would. Well, you mean out of the money? No. So if I start out of the money, Wesley, and the market goes against me, so let me read the question, because this is a very, very good question. Does the adjustment work on a normal call spread out of the money if the stock drops? It seems that the amount of the strike would not generate enough premium, and therein lies the issue. If I'm doing an out of the money call spread and I start out of the money, I am already hedging my position, if you will. Today's daily play, we did it. It was a great example. If you are a client and you check out the daily play, I did a very speculative trade on Amazon. And I managed my risk by going out of the money and lowered the overall cost of the trade. So if I'm going out of the money on a long call spread, I'm not going to really adjust it. It's just that simple. That's the way I trade my long call spreads. Is if I'm doing that, I'm speculating. I might be doing it because I saw a stock break out to the upside on the chart. And so I'm going to do a shorter term long call spread to try to take advantage of it. I'm trying to think of scenarios where I might do an out of the money one. But if you do it, it would be so tight that if the market started going down, it'd be very hard to be able to get a decent credit to make it worth your while to adjust it. Not saying it's impossible, and the underlying does matter. If you're doing it in, if you're doing the trade in, I'm trying to think. We did shop recently in the something that's trading around. Let's just use a number. I'm trying to think of something that's trading around 60% implied volatility. That underlying was. So if I have a very volatile underlying, then maybe. If I'm doing it in Walmart, not a chance, right? Right, not a chance at all. So there you go, Wesley. Okay. Well, thank you for your kind words, Forrest. I appreciate that. And I have to admit, I've done this presentation at least 300 times. I just got the math all screwed up. I was trying to combine my presentation that I did with the butterfly. And I know that's what it was because I used those slides. So I apologize. That's on me. That's on me. All right. Any other questions? Should we close the butterfly or let it expire? Now, Asian, I butchered your name. I apologize. So I'm just not going to try it again. Should we close the butterfly or let it expire? I don't mind closing it. If it comes back and hits your short strike of your butterfly, close it. Just close it. Just it might not get you out exactly at break even, but I don't want it to continue on up and just blow it away. So I usually close it, and once again, if I'm on Friday and it's noon, the SPX is cash settled. So that's a wonderful thing about the SPX compared to the SPY is that all that happens is it lands within your butterfly strikes within your TP. There's cash in your account where cash used to not be. And it's that simple. So I don't mind doing it, but if it comes back, I'm normally going to close it. If it runs away from me, I'm not going to adjust it anymore. Hi, can you see the visual separate spread price minus that decision? Can you see the I'm sorry if I lean forward. My eyes aren't what they used to be. Can you see the individual separate spread price to make that decision? You can. So you can set up an alert inside OptionsPlay to say, if this spread is trading at this price, let me out, or let me know. And then you would have to execute it at your brokerage platform. So Frank, I'm going to turn your question around. And really what Frank is asking is, when do I know that this, because I can't do it off of the price, right? I'm telling you from my years of experience, approximately when this is going to get to 2.5 or $2. And I'm selling it anywhere in that range. It gets down to $1.50. I don't know if that's really worth it. Maybe, but I might just close out the long spread at that point in time. Because I'm just not, I need to reduce my risk by a substantial amount to make it worth my while to do this. And to me, $2 out of a $8.75 trade, that's a substantial amount in my mind. Okay, so how do I make this decision? You want your platform, and I keep hitting, I'm trying to highlight things, so let's go back. And I keep clicking it to highlight it, but I can't highlight it. Okay, so if I'm in this position and I'm looking at this, this is what you're setting the alert on. You're not setting the alert on this price. You're setting the alert on this spread. And Wesley's got another great question. Even though you guys are doing the chat box instead of the Q&A, I am addressing them because I feel bad. I had my math all screwed up. Oh my gosh, I got a lot of other questions in here. All right, use this adjustment only for very short dated positions. Here's the issue, Wesley, is the butterfly needs time decay to work. The butterfly needs time decay to work. So I can do this with a longer dated position. I can go out 40 days and I can put the trade on and adjust it if I see my short call spread at the price that I want it. But if the market then comes back, the butterfly just doesn't reward me enough. In order for a butterfly to really pay out, you need to be closer to the expiration date. For example, and this is just by chance that this is in here, but you see this is as of today. When I set up this butterfly in the put butterfly seminar, this was as of today where that butterfly was at. Now, at expiration, you see the home run, you see the teepee. So one day goes by, this line moves up to here. Another day goes by, it moves up to here. And out of the 5 days, so this was a 5-day butterfly. This was a profit and loss graph to a 5-day butterfly. And this is where it starts. But by Wednesday or Thursday, you're hanging somewhere in here on the profit and loss graph. Okay. And let me try to address some of the other questions. Man, a lot of great questions. I really apologize. And I can, if you guys want, I'll do another one of these. Hey, Brian, okay, Wayne. Wayne's got a good question here. I have a NVIDIA bull call spread I bought. So now this one, Wayne, and NVIDIA, well, you should be doing really well if you bought an NVIDIA no call spread. On the 29th and add 145 call for $4. Oh, it has dropped. Oh, okay. So Wayne, you did it recently. Yeah. Wayne, that is a very plausible, what is the expiration? So can we see this question? If I pull it to my screen, I don't think you'd be able to see it, but I like this. Okay. So Wayne's saying, and NVIDIA is an underlying that you could do this on. Now, he said that I bought a bull call spread for the November 29th expiration. Okay, so now that's the only thing about this that's tough is that you're too far out. So if you're thinking about getting out of your bull call spread, Wayne, this is an alternative. But if the market whiplashes back and gets to your short strike on your butterfly and you have to November 29th, it's not gonna give you the hedge, the protection that you were hoping, because it won't be trading for too much more than where it's at right now. So you would need a little bit more time decay. If you were within the last 10 days to expiration on this, I would consider it. But at this point in time, if you're nervous, I would get out. You just have too much time premium. You started with too much time, Wayne. But I like NVIDIA going into November and October. you got plenty of time. I would probably just stay the course in it right now. But obviously, you're going to be hitting into earnings. Earnings are about a month out. They're usually a month after the main Meg 7 or the bulk of the main 7 announce. So earnings is going to probably be in that expiration at some point in time. Maybe it's December. I don't know if it's early December. Okay, so then another thing. What was your target on the SPX when you entered the trade? Didn't necessarily have a target, to be blunt. If I put this trade on, I just want the market to go up. So ideally, I think that the market's going to be bullish over the week, and this is a neutral to bullish trade. So if I get up, if I give it, so I could probably say it this way, that if the market was up about 1% from Monday, if I put it on Monday and on Wednesday the market was up 1% from that day, I would probably be good enough to get out of the trade. That's where my outlook would be. That's a strong move in the SPX. Now, recently we've had 1% and 2% moves, and this is abnormal to have those type of moves in the SPX at this point, or just overall over the many years. It's very hard for the SPX to move a 1 or 2% on a one-day period, let alone a week. Do you prefer starting with a call spread and then leg into a B fly? William, I don't mind starting with the call spread. This is my call spread. This is my bull spread strategy. But you could do it with a put if you were bearish. But remember, this is a chip in a chair strategy. And I'm using another analogy, but this isn't a perfect trade. If the market goes down, you're playing the hope game. But I'm giving you a way to play the hope game, because my experience with retail clients is that they don't play the hope game. They just let the long spread expire. They say, I'm going to get out when it gets down to, when I lose half of my value, but they don't. And then the market keeps drifting lower and they say, well, okay, if it gets back to half of the value, I'll get out. And it doesn't. And before you know it, you never get out of the long spread. You lost everything that was in the trade. And I feel like retail clients, retail traders can get on board with a strategy more like this, that you can ride to that expiration date and it gives you a reason to do it. So, but realize it's not, in order for a hedge to usually be good and reward you if the market keeps going, you usually have to add risk. And it's that simple. And when I put the next chapter in my book, that will cover these trades. And that is probably going to be the most profound statement of managing trades. Very rarely do you have an adjustment on a trade that adds no additional risk and reduces the overall risk of the trade. So if you adjust this trade and you're going with the market and you're saying, okay, I'm no longer bullish, I'm now bearish, and I hope that it's going to continue on down, bottom line is you're going to have to put additional risk onto the trade. It's just that simple. It's very rare that you can do that. Now, if I go out on a covered call and I own the stock and I roll that out, well, why do people like to do that? It's because they can do it for a net credit, but they've lost on the first trade that they put on. If I'm doing a covered call, for example, and let's just talk about adjustments, and I buy to close and I go up and out in strike and I get it done for a net credit, I've already locked in a loss on that trade. Here I haven't. I haven't locked in the loss because I haven't sold the position that I owned. I don't know if that necessarily matters, but the only other example of real adjustments where you're not adding additional risk, you're at least establishing a loss in your account by rolling an option up and out on a covered call, which I'm assuming most people have done in this room or understand that concept. Yeah, so Frank, I don't mind. If I'm doing a butterfly, I prefer to do shorter term, and I prefer to use big indexes. It's been kind of a trend. A lot of people like to just do a one-day butterfly in the SPX with all the zero DTEs. So yes, I do prefer to do the shorter time frame if I'm doing a butterfly because of the way that you get paid on the trade. The only one that I don't mind going a little bit longer on is the modified, not the modified, the skip strike butterfly. And that's mainly because I'm treating the skip strike butterfly when I do it as an alternative to a short spread. And if you watch the butterfly video, I go into great detail as to my idea of a skip strike butterfly. And the fact that I call it a skip strike butterfly has everything to do with it as an alternative to a short call or a short put spread. Sandra, thanks for the kind words. Okay, and Forrest had a trade. Yeah, you start, Forrest, if you do this trade, so Forrest, that presentation, actually somebody had commented on your chat, that presentation is actually the last presentation. When your butterfly stops flying is what the presentation was, something very similar to that title. So if I'm doing a butterfly, if I have a standard butterfly on or a modified butterfly, I don't do standard butterflies that much. That's my adjustment. But I prefer to do the modified butterfly where you have some risk. And in the daily play, I did one in the VIX index that's still very pertinent today. As a matter of fact, I will probably add to my VIX modified butterfly call position well, tomorrow, if the VIX is still trading around 22, I like it better than when it was around 19. So I'm still anticipating that after the big event, the election, and a few days into that we'll see the VIX start drifting back towards where it wants to be, right around the 15, 16 level, which is the mean. The VIX is always a mean reverting index. So if you go back and look at the daily plays and you look at the portfolio, if you are a part of the options play clientele or group or gaggle, you have access to that butterfly. And I would actually look at doing it again right now because it's going out till November 20th, which is the normal monthly expiration in the VIX. So a modified put butterfly, and I'll end with this one, okay, William? And like I said, this is a third-part series, and I might go back and redo this one. We'll see. Maybe I'll just do a recording and I'll post it. But I'll come back and redo it with where I don't have my numbers. I had my head just all screwed up on that one. But the modified put butterfly, I went into great detail. It was two events ago. Butterfly Breakdown was the name of the seminar. But when you modify my put butterfly here, I'm buying a long spread with the put, buying this strike, selling this strike. And that, let's say that gives us 10 points, right? And then on the other side, on the butterfly, the short spread, you are selling this strike and buying that strike. Well, you just drop short. You don't buy all the way down, right? So in this instance, let's say, and I'll make it very, very simple, the long spread is 10 points, the short spread is 5 points. Well, then you're still profitable if it goes below this strike. So you don't need it to hang right where your strike is in the middle. And if you're doing that, you're going to pay up a little bit more for your butterfly to start, right? Because you're just not going to get as much credit from the short spread to help pay for the long spread. Well, you can watch the video and then all you got to do is fast forward to the end. And I actually gave, in my mind, a pretty good presentation after I got my cobwebs out of my mind. And I'm saying cobwebs because, yes, it is Halloween. And cobwebs are a little bit of a appropriate statement. I guess. All right, guys, anything else? That's it. Thank you for coming. I stayed longer because I did mess up in the middle. Made a solid recovery though, and we'll see. We'll see where we end up. Thank you. The only VIX trade I have seen is a bearish debit spread. Bill? Yeah, that's right. That's right. That's right. Okay. Yeah, it's a bearish debit spread. You're right, Bill. Bill, you're right. I mixed it up again. Before going into September, I did the modified put call spread. But I want to get bearish in the VIX, Bill. I want to get bearish. I want the VIX to go below 16, and I think it can do it after this big event. We get through this season of earnings, we get through the election, and I think in general, the VIX will start coming back down and trading within the means. And not saying that the market's going up, market's going down. I just think that the market is very nervous right now. And the VIX wants to be at some point in time down around the 16 level. And that is what my outlook was. All right. Thanks, everyone. Have a very happy Halloween. And check out OptionsPlaybook.com. If you want to review those skip strike butterflies, I don't have the modified butterfly in there, but everything's available inside OptionsPlaybook.com. And obviously you can paper trade inside the Options Play platform. Try putting a few of those on, putting them into your portfolio, and then check them out. Understanding option pricing is everything that this is about, right? Understanding what happens as expiration approaches has everything to do with this adjustment that we looked at. Thanks for coming, and we'll see you soon.